is made easier when trusted hands lead the way, opening doors so we can venture out to explore possibilities, refusing to believe the undoable, but always embracing the unthinkable. Inspired thinkers always glued to the possibilities of great futures, embracing challenges with admired hope. A group of good people ready to give you a push as they create, build, and support platforms that steady our feet. Because we believe in new creations that are embraced by all, and changes that make life much easier to handle. This wonderful change is meant to connect our futures, because we understand in life the things that you desire the most are within reach when we unlock possibilities for you to do great things every day. Call us today on 0711 065 100.
Good morning and welcome to All Mutual Investment Group Kenya Quarter 2 2023 investment discussion. We are glad you've been able to join us. My name is Anthony Mwithiga. I'm Managing Director of Omig in Kenya. And I'm joined by my colleagues. On my right, John, who heads offshore investments, Steve, who is head of research and head of equities, David, who is our head of fixed income securities, and the gentleman on my extreme left, Kevin, who is our head of alternative investments. So welcome, colleagues, and welcome our listeners and viewers. This morning, we join you once again in our second investment discussion for 2023 to highlight the trends we've seen in this second quarter of the year from an economic perspective, and how those trends have shaped the various asset classes available to the investing public, specifically in Kenya. And I'm happy to say our asset class experts and heads here will provide us the insights we need to make better investment decisions and try to anticipate how those decisions will be affected in quarter 3 when the economic environment either changes, stays the same, or takes a left or a right shift economically. To start us off, I'll invite Steve to give us a brief macroeconomic overview of what has transpired largely in 2023, but more specifically, what is happening in the current quarter. Welcome, Steve.
Thank you, Anthony. So when you look at the current quarter and what has been going on over the last year, we've seen economic growth has remained positive. It was 4.8% for last year, and we expect it to remain positive in the current year. And what has changed quite a bit is inflation. Inflation has stayed high, and if you look at the latest inflation numbers for last month, May, they were at 8%, up marginally from 7.9% the previous month. And we think that will stay elevated on higher food and energy costs. Then when you look at interest rates, that has risen. We've gone from 9% to 11% over the last 1 year for a 1-year treasury bill. And that trend is expected to continue. We are likely to see those interest rates for 1 year keep rising. Then when you look at currency, the currency has weakened. We've gone from 123 at the start of the year to 138 now on the official rate. And that trend, given what's happening globally and where we sit as a nation, that trend we expect it slight weakening, but at a weaker rate, slower rate of weakening. Then looking at the stock market has weakened, but that weakening has been more driven by investors shifting to other asset classes such as fixed income rather than the markets, the companies not performing well. So we've seen the market come down by 17% in the current year.
Thank you, Steve. If I summarize what Steve is telling us from an economic point of view, he's saying interest rates remain elevated and they are rising. The currency continues to weaken, but trying to find a balance at current levels with a slight elevation. And thirdly, Steve is telling us we are still enjoying a positive economic growth with a positive GDP, though not expected to be as stellar as 2022. And lastly, Steve is telling us that inflation remains sticky and is expected to remain elevated, but with a decreasing trend as we enter Q3 and Q4. Now, John, if you listen to that prevailing macroeconomic environment for Kenya, how have you seen this environment connecting to the global world, and how has it affected offshore investors from Kenya investing abroad?
Yeah, thanks, Anthony. So just following up to what's happening from a global perspective, just looking at the economic growth globally. Economic growth, just like expected, is obviously positive. I think one of the key positives is that now China has come on board, especially after the reopening of China fully last year. That has come to give some impetus just in terms of the global economic growth. Secondly, on interest rates, globally interest rates have been on an upward trajectory. I mean, if you look at, for example, an example of the US interest rates have moved from 0% to 5% levels in the last 18 months. And that, of course, has been a lot to do with trying to tame inflation. So just like locally, inflation has been a very sticky issue globally. Now, just looking at the last 2 months, of course, in Q2, what we have seen is that inflation has been trending downwards from levels of, in most of the economies, for example, in Europe and the US, inflation had hit a high of 10%, largely on the basis of high commodity prices. But in the last, this year, we have seen a downward trajectory, which is positive, because now we are starting to see a likely scenario where a lot of these central banks are likely to start pausing the interest rate hike that you have seen in the last 18 months. So that generally has made the situation a little bit more comfortable for equity holders, or rather interest in equities. So equities market broadly have been on a positive trajectory. I mean, looking at, for example, the US market, looking at the key barometer, which is the S&P 500, on a year-to-date basis is up about 11%. Look at European markets, Chinese market, they're also quite up. But the key driver, especially in the last 2 months, has actually been the tech sector, which was very much impacted last year, but you have seen that now come back and also contribute positively. So I guess from a global perspective, I think the situation, especially for Kenyan investors who had invested offshore markets, has been quite positive, because also even those ones who had invested in interest-bearing securities, with interest rates having gone up, for example, in the US from 0 to 5%, those are quite some sharp returns in dollar terms. So I think the picture has been fairly positive from an offshore perspective. And then, of course, from a Kenyan perspective, given we have also seen a weakening of the shilling, just like Steve mentioned, obviously when you translate that, we're seeing some slightly better returns for Kenyan investors investing in offshore markets. Yeah.
Thank you, John. So if we listen to John, we get the view that local investors who've invested abroad over the last 9 to 6 months have actually enjoyed some stellar returns. And John, specifically, investors who have invested in equities, for example, global equities through mutual funds, how have been the experience from a return perspective? What numbers have you seen which local investors might have been able to enjoy?
Yeah, thank you. So just looking at the global equities, and looking at, for example, the developed markets. The developed markets have done quite well, despite some small shocks that were along the way. For example, you recall there were 3 banks that almost collapsed in the US, one in Europe, a big bank. So, but despite all that, I mean, there has been quite some strong returns. And as I mentioned, is because of, for example, some of the sectors that last year did not do quite well, like the big tech. They came back very strongly. So just looking at the specifics of the returns, investors who are in developed markets have done well. I think we have seen returns upwards of 15% in Kenya shillings terms. Also, investors in some of the select European and emerging markets have also done quite well. But I think, going forward, of course, there might be a few uncertainties and volatility, but it does look like any investor who has been in offshore markets, at least in the last 3 to 5 years, has done quite well, relative, of course, to most of the other asset classes. Yeah.
Thank you, John. So if we come back home in Kenya, we've had a briefing of the prevailing macroeconomic environment, which, if you look at the behavior of investors in Kenya for the last 36 to 60 months, including the 5 months of 2023, there has been a continuous bias to fixed income securities, David. Yep. And there must be a reason for that. How have investors who've shown that bias to fixed income securities, how have they fared? Yes. How has been the returns, and how has it affected the portfolios of both institutional investors and retail investors?
All right. Thanks, Anthony. So yes, the fixed income securities, and here we're talking of the likes of treasury bonds, investing in the government, treasury bills, bank deposits, corporate bonds, and even the likes of money market funds. So one of the reasons investors have preferred them is because of their risk profile. They're actually quite low risk in terms of other asset classes. But over and above that, we've seen them doing quite well. Steve has mentioned how interest rates have been rising. Inflation has been going up as well. So as an investor, you want a return that is beating inflation. So we've seen those interest rates rising, and you're able to invest and get double-digit returns. Right now, we are seeing all securities giving us double-digit returns. If you remember when you were here last quarter, maybe a 91-day treasury bill was below 10%. Right now, it's above 11%. So imagine if you had invested 3 months ago, it has already matured, you're now reinvesting it and getting an even higher return. So it has actually been a good quarter for fixed income investments. Of course, if you invest in a bit longer term, it becomes a bit risky for you, especially in an environment where interest rates are rising. So for instance, if you invested in a bond 3 months ago, probably a return of around 13.5% per annum. Right now, bonds being issued are above 14%. So you can see you're losing out a bit by going long term. But for short-term investors, it's actually pretty good because you just go in, once it matures, you're able to reinvest again at a higher rate as interest rates move higher. So it has been a good quarter for fixed income securities.
Okay. Yes. Okay. Thanks, David. So David is telling us that the bias to fixed income seems to still working, but with a bias to the short end.
Exactly.
Okay, thank you. Now, if I go to Kevin, Kevin, you are responsible for our strategy and agenda on alternative investments. Alternative investments remain relatively new in this country and to most institutional and retail investors. Listening to what Steve has explained of the environment currently we have been in since the beginning of 2023, how have alternative investments, and which particular alternative investments, have performed well or have been able to do what they're supposed to do, which I assume it's to have a negative correlation with traditional investments like stock market, the fixed income market, etc.
Thank you, Anthony. So when we talk about alternative investments, I think it's only fair I demystify what we are talking about. So in terms of alternative investments, are ideally investments that operate in the unlisted space, that are not listed at the Securities Exchange. And this is what these investments are classified and operating in the private markets. So just following through on the discussions that we've talked about macro developments in locally and globally with high interest rate and high inflation rates. For some of the investments that we already have, ideally in companies that are not listed and don't track daily at a pricing level with the movements in the market, some of the portfolios that have allocation in this space, we've noticed a bit of resilience in terms of performance. So proving the point that having spreading out the investments in different buckets, be it in fixed income, equities, offshore, and a little bit of alternatives that do not synchronize or move in the same direction as public markets, they provide some diversification play for investors. So, however, given the positive experience that we've had at that level, there's also been some challenges in respect of, with a high interest rate and inflation environment, there's been an impact on foreign direct investments. And so investors, there's been a move from be it domestic investors or foreign investors, just moving and focusing on more safer investments back home, especially for foreign investors, where they're focusing on allocating or defending their performance by investing in government securities that are now yielding at historical highs of 5% in the US, for example. So that has affected a little bit of demand within the alternative investment space.
Thank you, Kevin. If I go back to you again, so investments like in venture capital, in private equity, some structures of infrastructure, and certain aspects of real estate or property can also be classified as alternative investments. From what you're seeing, have those investments shielded investors from some of the volatilities and not so good returns which have been experienced in some of the traditional investment markets in the public space, like equities?
Thanks. Yes, indeed, they have. There's a lot of evidence, especially given some of the portfolios or clients or investors that we have and have exposure in these types of investments. There's some indication that these type of investments have provided diversification in this type of markets. As you may imagine, both fixed income securities with a high interest rate environment have had a negative impact from a valuation perspective, but also equities coming down. So both fixed income and equities being affected. Now, with alternative investments not tracking the daily movements of prices in comparison to, let's say, equities, we've noticed there's been a bit of defensive performance from this type of investments. Now, but also on the flip side, we've also seen quite a bit of resilience, especially in what Anthony described as venture capital, and this side ideally capital or investments looking for startup companies, companies with a very minimal history. And there's been indication of capital coming to Africa in comparison to other regions, showing some level of resilience, but still affected and coming down at lower levels of foreign direct investment. pretty much because of what is happening out there with a high interest rate environment and high inflation. Investors are still fairly conscious, even though they're still looking for those opportunities in these markets.
Thank you, Kevin. I think clearly what Kevin is telling us is that alternative investments have somehow shown their uniqueness in terms of providing a shield to the volatility we see in public markets. Now, and let's come to public markets, and where the most topical asset class in public markets is listed equities, and for that matter, Steve, local listed equities. I think Kenyan investors have had a lot to say about the performance of the local stock market. Not in 2023, even in previous years. How has the local stock market fared in the prevailing economic environment we've described? What has been the trends and what has been the reasons for those trends, which we are all aware have not been very favorable to investors at the equities market?
Yes, Anthony, you've said quite a bit. Yeah. So when you look at the market, how do you make your return on the stock market? There are two ways. First, you make a return from the company paying you a portion of its profits in dividend. Now, when you look at that aspect of the market, a company paying you a portion of its profits in dividend, that has done well. So if you look on average, banks last year, for every 100 shillings you put in, they were giving you 5 to 7% of it back as dividend. If you look at now, the average is 11%. So that means the earnings of those banks have done better. If you look at the manufacturing sector, they are also paying higher dividend yield. So they are paying you anywhere between 5% for some of the companies, all the way up to 13% in dividend yield. So on dividend yields, the market has done well. Now, the other way you make money on the market, on the stock market, is the price goes up. So you buy a share at 10 shillings, it becomes 12 shillings, you have a 2 shilling return if you sell. Now, that has not done well. So when we talk of the market not doing well, that's specifically what a lot of people have been focusing. And I think that's what you're thinking about. That has not done well. Prices have come down by 17% this year. And the main reason behind that is that people have been investing in other asset classes. They've been saying, rather than wait for the price to go up, why don't I buy a treasury bill or put my money in a fixed deposit where I will earn 10% or 11% as it is right now. So that's what's been happening with the market. Yes.
Okay. Thank you, Steve. I mean, Steve is very protective of local listed equity investors, and for the right reasons. But Steve, if I may, I have a follow-up question on you. Now that the market has been weak, I mean, prices have fallen by minus 17%, as you've told us, as measured by the all-share index in Kenya. What are some of the strategies investors who continue to invest in the stock market have put in place or shown to still safeguard themselves from the weak market while not taking a decision to totally exit the equities market?
So most investors have been taking the two strategies. One, buying companies with higher dividend yield so that they can get more income as they wait for the prices to recover. Two, buying companies where they think that the fundamentals are strong and the outlook of the company is strong and it can withstand the various economic cycles, whether it's up or down, and add on to those companies in their portfolios. So those are the two strategies people have been taking in the market.
Okay. So Steve is telling us it's been not very favorable at the stock market, but investors have shown some resilience in sticking there, especially if they have a long-term view, as we all say. Now, having listened to the four experts here discussing about different asset classes, before we jump to the views from an economic perspective for the next quarter, I just want to ask John, John, you spent some time in looking at the property market in Kenya. Since the beginning of the year, what trends have you seen in the local property market within the economic environment which Steve has described for us?
Yeah, thanks, Anthony. So in terms of property, I think the key macro that really impacts on the real estate, of course, is interest rates. Because if you think about it, a lot of financing is required to do projects and so forth. So the fact that interest rates locally have been on an upward trajectory, that obviously has meant that the cost of financing has significantly gone up. If you look at sort of like mortgage rates and the whole funding and so forth, that has obviously gone up. Now that of course has made it a bit harder for investors to access credit, especially for the financial institutions, given the high rate. And also just generally, banks have also gone a bit slow in terms of lending to the real estate. So broadly, that has impacted the real estate market, so to say. So if you look at, for example, valuations for property, we have seen a bit of strain there. If you look at even projects that are breaking ground, I think you may have noted there's a bit of slowdown just in terms of there. But just looking at broadly and going into some of the subsectors, it's not all gloom, so to say. So if, for example, I started with the residential side, the residential side, if you think about it, and really also coming to especially the low end of the market, that of course remains very much underserved. There's 2 million units that need to be constructed to house people. If you think about it every year, that number is growing by 150,000 units. So there is still quite a lot that can be done in terms of that. Of course, the high end of the market, again, that's quite oversupplied. So that we have seen a bit of slowdown there. If I come now to the office side has also been a bit slow, but it's good that now more and more corporates, of course, are coming back to take up physical space. So we are seeing some of the properties that are grade A, meaning they have good parking ratios, they are green and so forth. There's quite a bit of increase just in terms of occupancy levels. So that has slightly become better. If you go to the other subsector, which is retail, retail again, there are few big shopping malls that are coming up. I think the current one, we feel there's quite a bit of oversupply there. So what you're seeing is a bit more of sort of like neighborhood kind of small shopping centers just to serve a neighborhood. Those ones are becoming much more popular. And I think for most of them, if you look around, they are fairly, from a tenancy perspective, it's quite high. So that's tracking up quite well. On the industrial side, that I think is where there's quite some good traction. And that is backed by a couple of factors. So first of all, of course, e-commerce is taking root. So you need a lot of decentralized sort of logistical centers, So we are seeing a lot of effort going towards that particular sector. The other thing is data storage. I mean, if you think about companies and all the data that they have, they need to sort of like store it somewhere. So again, we are seeing an element of storage, cloud storage come up where companies have an option where they can be able to station their servers and so forth. So that is tracking up quite well. And then, of course, finally, hospitality, which is hotels and so forth. I think since COVID, everyone seems to be back to traveling a bit, meetings and so forth. So that sector occupancy levels now have gone significantly higher. So that's a good thing with that kind of recovery. So I think broadly, it's a mixed bag. Some sectors seems to be doing slightly better than others. But I think on the whole, obviously high interest rates have had some impact on the broader real estate sector. Yeah.
Thank you, John. That's quite a good summary of what has transpired in the real estate or property market locally in Kenya. But just to move us ahead, we have Q3 of 2023, just less than 4 weeks ahead on us. So I expect, as experts, you've already shaped your view of what is likely to transpire in the quarter starting of July up to end of September. And you are able to help our listeners, viewers, and investors shape at an advanced stage how their investments will be affected and how new investments will be executed. But before I ask all of us to speak about their specific areas, I will first ask Steve, just give us a summary of how the macroeconomic environment in terms of currency, interest rates, GDP, and inflation is likely to shape up in quarter 3 of 2023. Steve.
Thank you, Anthony. And just talking about quarter 3, it's quite close to quarter 4. So let's just talk about it till the end of the year, right? So if you look at currency, we expect currency to keep weakening, but at a slower rate than before, towards the 140 mark to the dollar. If you look at GDP, that's expected to remain positive, but not, so it's still going to remain positive, but that pace of growth will be affected quite a bit by what's happening to consumer demand. Because, you know, the more people have to spend on the basics, food and fuel, the less they have to spend on other things. Then, if you look at inflation, we expect that to remain elevated, mainly because of the cost of living, most of the basic items remaining at an elevated level. So we expect that to remain high. But you will see it trending downwards mainly because of what we call a base effect. So prices were quite high last year. So even if you have higher prices now, that rate of increase is not as high as before. Then when you look at the other one, interest rates, that we expect that to keep rising. And that will rise because of two things. One, there's appetite for borrowing from the government. Two, higher rates are needed because globally rates have risen. So a higher rate environment also helps our currency indirectly and also helps control inflation. Yes.
Okay. Thanks, Steve. So a bit of change in quarter 3 and largely to half 2 of the year, with a few tweaks on inflation and interest rates, maintaining the direction.
Yes.
So thank you, Steve. Now, Kevin, allow me to come to you on the alternative investment space. There seems not to be a huge change in the macroeconomic environment between quarter 2 and largely the next half of the year. From where you sit and see proceedings for the alternative investment space, what do you think is likely to shape the themes in specific areas of
Thanks. So we're seeing from our interactions with investors, essentially now they've become more conscious of, with this debt sustainability discussion. So, and a few question marks that were there, within the African region have been confirmed. So that concentration risk and comfort that investors had with, certain asset classes and exposure to probably sovereign risk has now put investors more intentional in terms of spreading out their investments. And we've seen now an intention to increase allocation into other asset classes that are less correlated or move in a different direction in comparison to, let's say, government securities. So, currently, the forecast going forward and what we are seeing from our side is a pickup in allocation into alternative investment space, and this could be spread out to different types of alternatives, ideally in companies that are not listed, and that's what we define as private equity. Some investors seeking out investments that have competitive return but have an impact from a societal perspective. So if it's targeting sectors like healthcare, education, and also agriculture that have some resistance or can defend against an inflationary environment like we are in. So there's been a lot of push or conscious effort towards that direction.
So Kevin, you are telling us that we've seen signs of possible increased allocation to alternative investments, and secondly, alternative investments which are likely to make an impact to society while delivering actual returns. And if I may ask, are those opportunities available in the country?
Yes, indeed. As the Old Mutual Group, we currently have um, an opportunity for investors that can tap into the alternative space, specifically in infrastructure. And so infrastructure has really proven to be quite defensive and perform fairly well in such an environment of high inflation, high interest rates. So we've been talking to investors in the market about this opportunity, engaging them, and the infrastructure space that um, the current opportunity operates in leverages on growth forecasts of increased urbanization, increased digitization, just focusing on the sub-Saharan Africa and focusing on those sectors that have been really resilient in this kind of environment. So we'll be happy to, and it's open as we speak to engage investors further on this opportunity and giving also double-digit dollar returns. So it's quite competitive.
Yeah. Okay. Sounds interesting and attractive from alternative investment space. That means investors are willing to allocate more funds to alternative investments. Returns seem to be double-digit positive in US dollar terms. And thirdly, there's a bit of impact to society from that space. And that impact is positive. Now, if I come back to our local situation, and traditionally, David, you alluded to us that fixed income has enjoyed extreme positive bias from investors for what it has done for a couple of years and what it has done in 2023 in the last 5 months.
Yes.
Now, given that there is a shift in some core macroeconomic parameters like inflation and interest rates, which tend to have a direct impact to fixed income securities, how are you seeing the fixed income investment space shaping up in Q3 and maybe largely to the rest of the year? And what are you seeing are the likely trends investors will be wanting to follow or to get into to preserve what they have enjoyed, the good returns they have enjoyed, as you have explained to us?
Yeah. Thanks, Anthony. So as we've seen, the outlook for interest rates is that they'll still go up, for especially in Q3. And in as much as inflation is slowing down, it is still quite high. Food prices, fuel prices, still quite high. So we expect it, in as much as they're not rising in the same level we saw previously, it's still high. So in that sense, we still believe fixed income will offer good returns for investors, because as interest rates move up, we're able to reinvest and get higher yields and higher returns for our clients. If we stretch it out to the end of the year, I mean, we're at a place whereby we're asking ourselves, where do we think interest rates will settle?
Yes.
At that point, you're not quite sure. So the best advice I'd give someone right now, keep it short term. As we've seen, you're able to reinvest at a higher rate as we move forward. And I mean, we as Old Mutual even have an opportunity to do that for you with our money market fund, which tracks these interests, these investments, and we're able to reinvest at a higher rate right now in double-digit returns. So it will be a good place for an investor to park in your money, looking at 3 months to 9 months in terms of a horizon. And the other beautiful thing is, even as interest rates might start coming down at some point, in that fund, we're already locking in these high interest rate instruments within the fund, that even as interest rates come down, we still have those high rates to be able to give you a good return as an investor.
Thank you. Thank you, David. And David is telling us that the the good performance of the fixed income space will continue, but he's advising that we will keep it short term. And one of the appropriate ways is to invest through a money market fund. Correct. To enjoy the elevated rates as the fund tracks rising interest rates. Correct. Now, Steve, allow me to come back to you in terms of aspects of local listed equities. I mean, investors have really been brave to stick to the local stock market and are carrying, as you've told us, a minus 17% downward revaluation from a price perspective. What do you think half two of the year, and specifically quarter three, will change to either make them stick to this asset class or look for other options to either to preserve their capital or to seek higher returns from other asset classes?
Thank you, Anthony, for the question. So in the second half, I see most of the investors would still prefer the other asset classes, such as fixed income, because of their higher rates. But long-term investors will still stay in the stock market, and you will see them buy counters that they think the valuations are very good or dividend yields are quite high. So that's what I expect in the second half of this year, especially Q3.
Thanks, Steve. If I go more specific, which sectors, the local stock market can be broadly broken down in 3 or 4 sectors. The banking sector is quite dominant in the listed security space, manufacturing, telecommunication, and there's a bit of services. Out of those 4 sectors, where do you think earnings of companies are likely to be sustained in half two of 2023?
So half two of 2023, most of the listed manufacturing, the large ones, will be able to sustain their earnings growth. Banking, yes, you'll still see positive growth. There's a bit of worry about NPL, but you'll still see positive growth. Telcos, resilience. So you'll still see positive earnings. So what you're likely to see is that for telcos, investors will be looking at price as an entry point. They'll ignore company performance. For manufacturing, people will be looking more towards what kind of dividend return should they get. For banking, people will still be looking at performance and just keeping an eye on the NPLs. Yes.
Okay. Thanks. Just to cap it up of what outlook we foresee out there. John, you've told us earlier that the offshore markets have had a stellar performance in 2023. Now, given we have a view of key macroeconomic parameters for the next half of years explained by Steve, how do you think the offshore markets will fare, given that they are affected both by what's happening in the larger global space and locally, what local investors investing abroad are going through in the still difficult economic environment? John?
Yeah, thanks, Anthony. So from a global space, in the next 6 months, I think it's going to be quite volatile. And that volatility is largely going to stem from the fact that, interest rates have risen very fast. I think in the last 30 or so years, we have not seen interest rates move up that fast, right? Within a very short period of time. As we said, they moved from 0% to 5%, especially in the US. Now, we think that might introduce some second round of impact, especially to households and companies, which might make, for example, financing costs, for example, become a bit of a challenge. So that might introduce some volatility. Secondly, the geopolitics of the day. I mean, every single day there's always news about certain things globally. So we think those 2 factors could dampen the performance a bit. So I think the offshore investors need to be also a bit more cautious and a bit more long-term in terms of their view. But of course, the best way to have that is obviously to also look at some of the sectors that are likely to do well, even if there's that kind of volatility. So if you look at, for example, sectors that are less impacted by volatility, for example, your healthcare and so forth, which some of these global markets do offer, and some of the specific funds and so forth do offer, it makes sense to be quite well diversified across. But does look like the next 6 months, there's likely to be a bit more volatility going forward. I think after that, the world seems to be factoring in some sense of interest rates coming off in 2024, 2025. And therefore, it makes sense for investors who have a long-term view to also take advantage of any volatility in the second half of the year to allocate, of course, as they look for better returns into the medium term. Yeah.
Thank you, John. As we come to the end of our discussion today, we have a couple of questions which have come through, and I think I'll ask all of us to take a minute each to respond. David, there's a question about government borrowing, and the question asks, will the government of Kenya be able to continue paying its debts, or will it be unable to pay and default?
Wow, that's a tough one. So we've seen a bit of challenges in African economies in terms of sovereign debt. And even if you zero in, especially on East Africa and specifically to Kenya, there's a bit of worry about that. And I think that comes from the fact that we have a Eurobond maturing next year. And people are wondering whether the government will be able to repay the money back to the investors. And I think the key thing is, one, where they'll get this money to be able to repay, and two, at what cost. Yes. So those are the two main issues. But what we've seen is that the government right now has shortlisted arrangers for a new Eurobond, which will go into refinancing this one. They've shortlisted 4 companies. They did an expression of interest, and there were very many people who actually showed interest. So it means there are people who are seeing specific ways of assisting the government to be able to refinance this. And the other thing we've seen is that the government is still issuing local treasury bills and bonds, which are very well, the participation is quite good. So it means people are able to have confidence in the government being able to repay its debt. But anyway, early days in terms of the arrangers, so we'll wait and see, and so that we can be able to see what the government will do going forward. Thanks. Yeah.
Thanks, David. And there's a question here about the stock market. Very briefly, Steve, and this is somehow what you have explained. Why has the stock market kept going down?
So if you look at the stock market, what has actually brought down the prices has been a big exit of investors, especially the foreign investors. And that's been driven by what's been happening globally. Interest rates have gone from 0.25% in the US to 5%. So the cost of doing, let's say, doing nothing with your money is now you can earn 5% in US dollars without doing much. So a lot of investors have been pulling out to go into asset classes such as those. So foreigners were pulling out because of that. So that's been the main impact in terms of the market. And then locals have not been coming in adequately because they've been going to other asset classes, such as fixed income, which had higher rates at the same time. Local fixed income. Okay. Yes.
Okay, thanks. There's a question here about the property market. John, why has the government been too keen to build houses for Kenyans?
Very hot one. Yeah, I mean, I think let's go to, obviously, the numbers. I mean, a house is a basic need for everyone. And just looking at the statistics, as we said, we currently need 2 million units to house Kenyans. Every year, that number is growing by 150,000. So definitely, there's obviously need to build more units, more houses, of course, to settle the citizenry. I guess the key issue is about the financing side of it. I mean, as you're all aware, real estate and so forth, it's a heavy capital-intensive kind of exercise. So the issue around financing of those kind of developments, that comes into question. So I guess that's why, of course, there's all these discussions around how then is the best way to finance, the residential sector. So I guess that's why you're seeing a lot of consultations across from government, stakeholders, financiers, and so forth. Of course, there are also entities such as Kenya Mortgage Refinancing Corporation that's now coming into play. I guess the whole idea is to try and address the issue. So the opportunities are there. I guess it's just a bit more of stakeholder engagement to see what's the best way out in terms of financing the sector.
Yeah, there's a question which has just come in online, and I'll ask Steve to take this briefly. I think it's pertinent in what is happening. We're in a government budgeting cycle for the financial year 2023-2024. And the viewer or the listener is asking, what's the likely impact of the finance bill to the economy? Very briefly.
Right, briefly. The finance bill is just a set of proposals on how the government will raise money. All right? And then the budget is how the money that's raised is going to be spent. So that impact is several, because there are several aspects. But I would say when you look at what the proposals are in the finance bill, is that taxes will rise in certain areas, and there'll be new levies such as the housing levy.
Okay, thanks, Steve. There's a question here for Kevin about alternative investments. What opportunities are there now for an investor who is ready to invest?
Very many opportunities, very many, quite diverse. So from an alternative investment space, you can access different sectors, be it investing in startup, in companies, or the next household names for the future. As All Mutual Group, we are engaging investors at this point in time to invest in an infrastructure fund, where the investor can seek for competitive returns, but also have an impact at the same time. And the fund ideally is hinged on 3 pillars. So one is digitization. So we're talking of data centers, telecommunication towers. As you may imagine, now you're going from 4G to 5G, and this will increase the density in terms of the number of towers and the like. Second is clean energy. So we're talking of wind power, solar, contributing to the energy demand supply gap in a clean way. And the third one, of course, is on the back of urbanization. Then there'll be demand for increased mobility of people, but also of goods and commodities. So in this space, airports, roads, ports and logistics. Okay. So you can access those investment opportunities through that fund that we are currently engaging investors. And I urge them to make contact with us or through their financial advisors. Okay. to get more details about the fund. Yeah.
Okay. Thank you, Kevin. I think well said on that opportunity existing in the alternative investment space, specifically in infrastructure. So our listeners and viewers, we've run short of time to respond to all of your questions, but we've responded to all the burning ones, and thank you for sending them through. So as we conclude, and having listened to the asset class experts who have joined us this morning, 2 broad things have come out. One, the current investment environment is challenging, whether it's from a currency perspective, inflation, or interest rates movement. But within that challenging environment, all the asset classes which have been discussed here offer opportunities and also provide an opportunity to manage the risks which come with those challenges. So what should investors do? As All Mutual Investment Group, we believe investors should do 3 main things. One, they should keep close to their investment advisors and investment professionals and get concurrent updates on what's happening to the economic environment and how that is affecting their existing or legacy investments. Secondly, investors should embrace new investment opportunities which have less correlation with the traditional investment markets, and hence the discussion on alternative investments, as alluded by our colleague Kevin here. And thirdly, investors need to think broader than our own boundaries. John has spoken about the stellar performance of the offshore markets in the first 5 months of this year. Regardless of the challenges available globally from volatility and currency challenges, there is still opportunities for local investors to invest outside their natural comfort and traditional boundaries. And with that, we would like to state and make it clear that the best asset class is actually not offshore investments, not local equities, not real estate or property, not fixed income securities, or not alternative investments, but a well-balanced portfolio cutting across all the available asset classes. Thank you, our viewers and listeners. We are grateful you've been able to sustain listening to us. And from all of us, we look forward to engaging with you in Q3 at the next Omig Kenya investment discussion. Thank you and have a good afternoon.
We all want to preserve great moments in life. And this is made easier when trusted hands lead the way, opening doors so we can venture out to explore possibilities, refusing to believe the undoable, but always embracing